Hello everyone and welcome to ACCA Practice to Pass webinars for March 2022 exam session. First of all, let me introduce myself. This is Zia Rana and I'm ACCA member and also teaching since last 8 years, and my core teaching areas are UK taxation, the advanced taxation and the financial reporting. And I also worked at KPMG's taxation department around 3 to 4 years. Without wasting time, now we can move forward and can discuss the things which we are going to cover in today's session. As you guys have already attended previous 2 sessions with Sir Kambar Raza, now it's day 3, and what's our today's plan to cover? That is, we are gonna cover 2 exam question of the recent attempt, the September-December 21 exam question 3, and for the same attempt, the exam question number 4. Rest of the things have already been discussed with respect to the passing rates and all that. So hopefully you enjoyed and learned multiple things in previous 2 sessions, including the CB practice platform questions. And as we would be covering like exam question 3 of September-December 21 and exam question 4, our strategy will remain same as of previous 2 sessions as conducted by Sir Kambar Raza. So what's our strategy basically? First of all, we would be quickly recalling the respective areas which examined in these questions, and then we will start practicing question using ACCA CB practice platform. So now let's start discussing the things with respect to exam question 3 of September-December 21 exam session. In this question, different areas are basically tested, and let's discuss one by one. Keep remember, we are actually recalling the areas of the exam question of the attempt September-December 21 and with respect to exam question 3. So what are the areas being tested in this exam question? The first one is about the terminal loss and the availability of the relief. Which relief? By adjusting the terminal loss with the other income in the previous year's income as according to the concept. First of all, what is actually termed as terminal loss? Any loss which arise in the last 12 months of trading is termed as terminal loss. I repeat, any loss which is the last 12 months loss before cessation of the business. And very importantly, we are talking about the trading loss for individuals, as well as this concept is also available for companies. But here we are actually discussing the terminal loss and its treatment with respect to individual persons. So what exactly is this terminal loss? It is a loss which arises in the business cessation time period, and the last 12 months time period loss would be treated as terminal trading loss. First of all, let me complete the areas one by one, and after completing each area, I would be responding to your queries as well. Please don't worry for this thing. If there is a trading loss, what will happen? How to adjust that loss? In the next step, you can see terminal loss relief can be adjusted from the trading income of last 3 years or 36 months on a last in first out basis to the maximum possible extent. An individual person can get relief by adjusting this terminal loss from the 3 previous years trading income on a last in first out basis to the maximum possible extent. Although at the same time, apart from the terminal loss adjustment, although other options like current year adjustment or from carryback adjustment from the total income or from the gains, an individual can also use other options as well. But specifically, how to adjust this terminal loss? Let's take an example. Let's say a business is seized in the fiscal year 2021, and I'm going to write trading profits or losses by the name trading income. So last 3 fiscal years will be 19-20, 18 and 19, and 17 and 18. If any terminal loss calculated, let's say in the last 12 months of trade, so this loss, by the way, instead of loss, we always report the negative amount as nil. And let's say there is trading profits available in the 3 previous fiscal years. Now, at time of business cessation, an individual can get relief by adjusting this loss on a last in first out basis. What is last in first out? On a first priority, loss would be adjusted from 19-20, then the trading income of 18-19, then the trading income of 17 and 18. So this is how an individual person would be getting terminal loss relief by adjusting it from the trading income of 3 previous fiscal years on a last in first out basis. Furthermore, as we normally study is that at time of business startups, when a business starts, there are normally the overlap profits. I repeat, when an individual person starts a business, so normally there are overlap profits calculated at time of business startups. So that overlap profit will also be deducted at time of business cessation. Another important point to highlight is that any overlap profits will be deducted from profits or losses at time of business cessation. So the first area which is actually examined in this part of the question with respect to the terminal loss adjustment for individual person. Hopefully all of the things are clear. If you have still any unclarity in mind, you may please ask in the chat box. All right. So let's move forward and let's discuss about the assets and the disposal of assets and the capital gain implication on the disposal of assets. Assets are actually classified as the chattels and non-chattels. Chattels are the assets which are of tangible or movable in nature, whereas non-chattels are the assets which are intangible or immovable in nature. Then chattels are further categorized into two subcategories, the wasting chattel and the non-wasting chattel. And same case with the non-chattel, further categorized into wasting non-chattel and non-wasting non-chattel. Before moving on, let me write an important point over here. Wasting assets are the assets having useful life of less than 50 years. Wasting assets are any assets which have useful life of less than 50 years. So the chattels and non-chattels are further categorized according to their lives. Wasting means the asset life will be of less than 50 years, and chattel means asset will be of a tangible and movable in nature. The tax treatment, the capital gain tax treatment is that if any of these assets are disposed of, they are exempt from capital gain tax. And the best example for the wasting chattel is plant and machinery. Keep remember, the plant and machinery are always exempt from capital gain taxes and nothing to do with the CGT at time of disposing any plant and machinery. Second one, non-wasting word used because the asset life is more than 50 years, and the word chattel is used because asset is tangible or movable in nature. Examples of these assets are the antiques and arts, vases, any old paintings, the precious metals like gold or silver. So whenever any of these assets are disposed of, they are being considered as non-wasting chattel, and importantly, there could be any of the four situations at time of disposing a non-wasting chattel. What are these four situations? At time of disposing a non-wasting chattel, first of all, do check whether the disposal proceed or cost, if both are less than 6,000, the non-wasting chattel is exempt from capital gain tax. If the disposal proceed or the cost of asset are more than 6,000, so we have to perform the normal calculation. Normal calculations means from the disposal proceed, we deduct the cost and find the gain or loss amount. Number third, if the disposal proceed of less than 6,000 and cost is more than 6,000, then ignore the actual disposal proceed and deemed disposal proceed would be considered as 6,000. In the last scenario, you can see disposal proceed is more than 6,000, whereas the cost of non-wasting chattel is less than 6,000. In this scenario, the gain would be the lower of the normal calculation or the 5/3 rule. Normal calculation, again from the disposal proceed, deduct the cost of asset and find gain or loss. What is 5/3 rule? It's a simple formula, 5/3, the disposal proceed minus 6,000. So keep remember, at time of disposing a non-wasting chattel, there could be any of the four situations, and we would be applying all these things while attempting the practice question after the discussion of the relevant areas. Let's talk about non-chattel. Any asset which is intangible in nature or immovable in nature that asset would be the non-chattel, and vesting means the life of that asset is less than 50 years. Few examples are in front of us. Patents, the copyrights, or the leasehold land, all these are classified as vesting non-chattel, and at time of disposal of this asset, from the disposal proceed, deduct the cost and find the gain amount. It seems like normal calculation, but specifically for the cost calculation, we should be using this formula: the original cost divided by the total life of asset multiplied with the remaining life of asset at time of disposal. So for vesting non-chattel, for the calculation of the cost, this formula will be used. And the fourth one, non-vesting non-chattel. Non-vesting means life of asset will be of more than 50 years, and non-chattel means asset is of intangible or removable in nature. And the tax treatment is that perform the normal calculation at time of disposal of these assets. And here we have the few examples like freehold land and building, any shares, any goodwill. At time of disposal, any of the assets, normal calculations will be performed. Any questions, please? We discussed this area keeping in mind the capital gain tax implications on the assets which being disposed in a fiscal year. Okay, let me answer your query. At time of disposing any non-vesting chattel, there could be any of these four situations. We should check whether the disposal proceed or cost, if both are less than 6,000, the asset will exempt from CGT. If both are more than 6,000, we will be performing normal calculations. If the disposal proceed is less than 6,000 and cost is more than 6,000, ignore the actual disposal proceed and take the deemed disposal proceed as 6,000 pounds. If the DP is more than 6,000 and the cost is less than 6,000, then the gain would be the lower of the normal calculation or the 5/3 rule. Hopefully your query is now clear. Okay, moving forward, we also study another area in the capital gain taxes with respect to individual persons capital gain taxes. The name of this business asset disposal relief, BADR. Previously, before Finance Act 2020, in the previous Finance Act, the name of this relief was entrepreneur relief, but now there is no concept of entrepreneur relief because this business asset disposal relief has now replaced the entrepreneur relief thing. This business asset disposal relief is available for individual when an individual person dispose any of these four assets or things. I repeat, business asset disposal relief, this relief is available for individual person when an individual dispose any of the four things which are listed below. Number one, disposing of complete or part of business. Number two, if an individual person is selling the share of partnership, BADR would be available. Individual assets are being sold at time of business cessation. Let's say an individual person is going to cease the business, and after cessation, if any assets are being sold within the 3 years time period, so the person can claim business asset disposal relief. And if the person is disposing the shareholding, on disposal of such shares, this relief can also be claimed But for shares, there are certain other three conditions are there. Company in which person is having shareholding, person should be the employee of that company. It could be the part-time employee or full-time employee, and means another condition should also met. The person should own at least 5% of the shareholding or the voting rights in that company. For claiming business asset disposal relief, at time of disposing shares, there are certain conditions. The person should be the employee of that company and should own at least 5% of the ordinary shares or the voting rights. And another condition which is commonly checked for all these four types on which BADR can be claimed, the common condition is that the assets must be owned for at least 2 years prior to the disposal, and the asset must be the business asset. This business asset disposal relief is not available on the disposal of investments because investments are not a business asset. So let's conclude the things. Business asset disposal relief is available for an individual person when that person actually disposes any of these four things. And the common condition is that the asset must be owned for at least 2 or more years prior to the disposal, and asset must be the business asset. BADR is not available on non-business assets, as well as BADR is not available on the disposal of investments. Another thing is that this relief, BADR covers the first 1 million of the qualifying gains that an individual make their lifetime. Very important to understand. There is a lifetime available limit for an individual person, and the lifetime limit is 1 million. Means, let's say in previous fiscal year, a person disposed its complete business and the gains qualified for BADR. In the current fiscal year 2021, he disposed a share of partnership and any gains qualified for BADR. Let's say now person is disposing multiple things from any of the four listed above, but the max gains which can qualify for BADR to the extent of 1 million for the whole life. It means any gains which qualified for business asset disposal relief upon meeting of all these conditions, so those gains would be taxed at a 10% rate. By the way, in CGT we know that there are basically two rates, 10% or 20%, and at time of disposing residential property the rates are 18 or 28. But if any gains qualify for BADR, on such gains the rate of CGT is straightforward 10% regardless of the taxable income or the status of taxpayer. Normally, how we decide the rate of tax? We decide the capital gain tax rate by finding the status of taxpayer. If a person is a basic rate taxpayer, he or she would be paying capital gain tax at a rate of 10%. And if the person is of high rate taxpayer or the additional rate taxpayer, that person would be paying the capital gain tax at a high rate of 20 or 28%. But irrespective or regardless of the status of taxpayer, if any gains qualified for BADR, then those gains will be multiplied, will be taxed at a rate of 10% regardless of the status of taxpayer. Okay, what next is there? We are actually quickly recalling the areas which are tested in the exam question number 3 of the September-December 21 exam session. The next area is with respect to commercial structure and building allowance. This concept recently introduced at TX or ATX level. Commercial structure and building allowance. In trading income of individual person or the company, few expenses are allowed trading expenses, few expenses are disallowed trading expenses. So as capital allowance is available on plant and machinery, that is an allowable expense. Same case, this commercial structure and building allowance, SBA, is also an allowed expense to be deducted from trading income. SBA relief is given as an annual straight line allowance of 3% over a 1/3 years period. 33 years and 4 months basically. It means structural and building allowance expense can be calculated at a straightforward rate of 3%, as we also calculate capital allowances but on different rates. Like the main pool rate is 18%, any special rate pool assets having a rate of 6%. So here for the SBA thing, the tax depreciation rate is 3%. Furthermore, SBA is only available Yes. So as we are discussing about SBA, SBA is available where the building or structure has been constructed on or after 29th October 18. So this date is practically applicable in UK, but for our exam perspective, SBA would be considered from 6 April 20. So if any commercial building or structure is purchased after 6 April 20, on such building and structures, we would also be claiming SBA. Now, let's discuss the key features of SBA, how it works, how to claim this expense. Offices, retail and wholesale premises, the factories and the warehouse can all qualify for SBA. Importantly, the value of land is excluded, means SBA would only be available to the value of the structures, not on the value of land. And if a person acquires any factory, so from the total consideration paid, first of all deduct the value of land and then calculate the SBA for tax deduction purposes. Expenditure which qualify for plant and machinery cannot also qualify for SBA and vice versa. Let's say normally on plant and machinery items, we claim capital allowances. So on such assets, SBA would not be available, whereas on commercial structures and buildings, we claim SBA. So capital allowances would not be available on commercial structures and buildings. Next point, where an unused building is purchased from a builder or developer, then qualifying expenditure would be the price paid less the value of land, as also discussed previously. The building or structure must be used for a qualifying purpose or activity, means that asset should be used in the trading purposes, not for any other non-trading purposes. The SBA can only be claimed from when the building or structure is brought into qualifying use. Let's say you purchase a building on 6 April 20, very first day of the fiscal year 2021, but you started using the same building from June 20. So purchase date is irrelevant for claiming SBA, whereas the use date becomes relevant at times when we would be calculating the commercial structure and building allowance. Next point, the separate SBA is given on each building or structure which qualifies for SBA, and relief is also given for the cost of subsequent improvement or where a building is renovated or converted. Let's say first of all, in the current fiscal year of 2021, you purchase the building and thereafter you also incurred a capital expense like any improvement or any enhancement on such building. So on such expenses, on the capex you incurred, on those amounts the SBA would also be available. The next point with respect to the disposal of the building or structure, there is no balancing allowance or balancing charge is calculated at time of disposing the commercial structure and building. As normally we do is that at time of disposing a plant and machinery item, we normally take the balancing allowance or the balancing charge, but no balancing allowance or balancing charge will be calculated at time of disposing commercial structure and building. The allowances that have been claimed by the seller, these are the implication of the disposal of the building or structures. Any allowances that have already been claimed by the seller, they would be added to the disposal proceeds, means they will be clawed back. Any expense, any SBA which claimed before disposal, that would be clawed back, simply means that will be cancelled out, and the seller must be added the amount to the disposal proceeds in order to determine any chargeable gain or allowable loss on the disposal of commercial structure or building. Next point, the purchaser of the building. Now the implication are for the purchaser. So here we have the implication for the seller, and now what the purchaser will do after buying this commercial structure and building. The purchaser of the building simply continues to claim a 3% SBA allowance based on the original cost for the remainder of the useful life, for remainder of the 33 years and 4 months life. Now, important thing to highlight is that what is the original cost? Let's say, for example, Mr. A actually developed or constructed this building for 500,000, and after purchasing this, SBA claimed and all that as discussed previously. But now after, let's say, 4 years, Mr. A sold this commercial structure to Mr. B for, let's say, 750,000. Now here are the implications for Mr. B. The purchaser is now Mr. B, will also be claiming a 3% capital allowance based on the original cost. What does it mean? The original cost means not on the cost of paid by new purchaser. Still, the new purchaser would be claiming the SBA on the original cost, and the original cost being incurred by Mr. A. So Mr. B would also be claiming SBA on the same value of 500,000 at a rate of 3%. Any amount which paid by Mr. B is simply ignored for SBA purposes. So we have nothing to do with the consideration paid by Mr. B, because according to taxation rules, the purchaser would be claiming SBA based on the original cost, means the actual cost of the first owner. Any questions, please, with respect to the commercial structure and building allowance? I'm looking towards question in the chat box, and I would really appreciate your active participation in this session. SBA would not be considered as incidental cost. However, it would be added to the disposal proceed of the seller. No, we should prepare our exam from all perspectives. Nothing we can leave. Actually, all things are important. So try to cover as much as possible for preparing your exam. Okay. Now let's talk about the last area which tested in exam question September December 21 in exam question 3, that is research and development. Very much important from exam perspective. Yes, very right, Wahid. At time of disposal, if any allowance claimed before disposal in the previous years, that allowance will be cancelled out or clawed back, and the same amount, the total amount of allowance claimed before disposal, would be added to the disposal proceeds. Hopefully all the things are now clear, so we can move forward. Thank you all. Research and development. By definition, it is same as accounting definition as we normally study in IS 38 intangibles. Research is any study to gain knowledge, but development is using that result of the research. If a company start preparing anything, if a company start developing any other thing, so that is the development phase. So by definition, it is same as accounting definition as defined in IS 38. By the way, investing in research and development, actively looking your answer in the chat box. If a company is doing research and development, if businesses are doing research and development, is it good for economy or not? Yes, quickly, please. Yes, obviously it is very beneficial for economy. Why it would be very beneficial? Thank you all for your quick responses. Because if yes, it is beneficial for economy, it is good for economy that companies are doing research and development. What they want to achieve by this research and development thing? If yes, it means the company or the businesses are trying to bring the innovation in their products, or they want to increase the efficiency, like the efficient processes, or they are trying to reduce their costs by researching and developing, or improving processes. All these are the bottom line results of research and development. So it is good for economy overall. If research and development thing is good for economy, due to this thing, tax authority incentivize or promote the companies by giving certain reliefs on the cost incurred by those businesses on research and development. Let me repeat. As the companies are now doing research and development, so at the same time, the taxation authority incentivize or tax authority promote those companies or businesses by giving relief on the cost incurred on research and development. For tax purposes, first of all, we would be calculating the eligible expenditure. Eligible expenditure for research and development purposes, and on this amount of eligible expenditure for research and development purposes, taxation authority will be incentivizing the businesses. But the first thing is, what is the eligible expenditure for R&D purposes? Staff costs can be taken, any software or consumable items which directly acquired for research and development purposes, any subcontract work, agency cost, small portion of whole research and development. Let's say if a company is doing the main research, at the same time company actually engages another company for certain portion of work. So in that scenario, only 65 of the expenditure would be qualified as research and development. Next thing, the journal overhead should not be included in eligible R&D expenditure because these are the journal overheads. They will arise irrespective the company is doing this research and development or not. Assets or expenses should not be considered for eligible expenditure, which are not wholly and exclusively incurred for this purpose. And any assets or expenses would be added to the calculation of eligible expenditure if any asset or expense which wholly and exclusively incurred, purchased, acquired for research and development purposes. Now, till now, we just discussed the research and development, and tax authority will incentivize those companies who engages in research and development. But for giving that incentive, first thing to check the eligible expenditure amount. Now, let's say we concluded that how to calculate this eligible expenditure, what will happen then? How the available relief on eligible expenditure works. First thing to check whether a company is a SME, small or medium sized entity, or a large company, because eligible expenditure for R&D purposes and its relief treatment is different according to the size of the company. However, if it is a large company, it will be mentioned in question, and as far as if it is a small company, that will also be mentioned in question. So no, you are not required to get worried about this thing, whether you would be checking whether a company is small or large, or it will be given in question. So let me clarify, it would always be given in question whether a company is a small, if a business is a small or a large company. Let's talk about SME companies, because an area with respect to SME company tested in exam question, which we are gonna cover after this discussion. Whenever there is a small and medium-sized entity and engaged in research and development, so on the amount of eligible expenditure for R&D purposes, what will happen then? That business, that company, that small and medium-sized entity can deduct 230% of the expenditure from the trading profits. Means an additional 130 of the actual expenditure would be deducted. 100% is the actual eligible expenditure plus 130 additional, so it is giving you 230% of the total expense can be deducted from the trading profits. In step 2, after this deduction of 230% of the expenditure from the trading income, if trading income is still a positive figure, that's fine, that's okay. We can deduct expense in full, but importantly, if trading income is calculated as negative figure or in a loss-making situation, if a business is a loss-making business, then to adjust that loss, now the company has two choices or options. Option 1 and option 2. Option 2 is that if the overall amount is a negative figure or company is a loss-making company, so company can deduct the loss as normal from the current year or by carrying it back or carrying forward. But under option 1, company can use the surrender option as well. What does it mean? Simply means surrender the loss amount and get a repayment from HMRC at 14.5%. Means forfeit the loss and get refund at 14.5% from HMRC. And the surrenderable loss on which the company would be getting a repayment from HMRC is the lower of the 30% of R&D expenditure or the trading loss after current year claim. So all these things with respect to small and medium sized entity is being tested in exam questions. So first of all, we recall all of the areas. Let me show you from start. First of all, we discussed the terminal loss and its relief. Thereafter, discuss the concept of assets disposal and their relevant tax treatments. Furthermore, another area we recalled with respect to business asset disposal relief, and then commercial structure and building allowance. Finally, we're done with the discussion of research and development, but keep remember with respect to the SME company only. However, if the company is a large company and doing the research and development, so large company would be getting a tax credit, a tax income, a tax receipt at 13% of the eligible cost incurred. And this 13%, who will pay this 13% amount? Obviously, the HMRC would be incentivizing the company and they would be making a payment to that company at 13% of the expenditure incurred. But any amount received from HMRC would be considered as a taxable receipt and it would be added to the income sheet pro forma, means a corporation tax liability will also arise on the income received from HMRC at 13%. Now we're done with the discussion of the areas tested. In very first question we are gonna do now. So before starting the question, if you have any queries in mind, you may please ask. I'm looking in the chat box for your questions. Relief means amount will be deducted and credit means amount would be added. Relief means you are decreasing your overall income, whereas credit means you are adding up your income. So as it is written over here, tax credit means you would be getting a payment from HMRC at 13% of the cost incurred. Hopefully you are now clear. Yes, please. Any other questions? Tax credit would be added to the income, so overall income will increase, and if income increase, tax liability also increase. For example, a company trading profit before R&D expenditure is 1 million and research and development expenditure is 100,000. Adjusted trading income will be 900,000. As we are discussing, for large company would be getting a receipt at 13% from HMRC, means on the eligible expenditure of 100,000, HMRC would be paying a 13%, means 13,000. So we added the 13,000 to the adjusted trading profits. Now the total income is calculated as 913,000, and on this total amount, corporation tax at a rate of 19% is applicable. So resultingly, the total tax liability is calculated as 173,470. Any other queries, please? Gorak, don't worry. We would be doing all these things while practicing question. Okay. Now let's move towards the past exam question. And here we have September-December 21 exam. As marked over here, the first question for today's discussion is the exam question of September-December 21, that is exam question 3, and that is section B type question. Let's use Navigator to directly move on question number 3. General information is given, so let's start reading this question very carefully. You should assume that today's date is 1st September 21. SEBI requires advice on tax implications of ceasing his loss-making unincorporated business and selling his business assets. That's all. SEBI requires advice on the tax implication of ceasing his loss-making unincorporated, means a sole trader business that was a loss-making business and the business is seized. What are the tax implications? SEBI is looking for advice. Along with the other thing, and selling his business assets. On the disposal of business assets, if all of the conditions are met, that business can qualify for business asset disposal relief and all that, as we just discussed previously. So it's all about the first person. Patent Limited, that's a company, is seeking advice in respect of corporation tax relief available for capital expenditure, and which capital expenditures are actually being incurred by the company, and for expenditure related to research and development activities. Read again. Patent Limited is seeking advice in respect of the corporation tax relief and for capital expenditures and for expenditure related to research and development activities. The following exhibit, that is exhibit 1, available on the left hand side of the screen, provides information relevant to the question. Exhibit 1, SEBI and patent. The information should be used to answer the question requirements within your chosen response option. But before reading the scenario in exhibit 1, first of all, read requirements carefully. And after reading the requirements carefully, then we will be reading the scenario by keeping the requirements in mind. So it will not be a journal reading thing. If you read requirements first and keep the requirements in mind, and then if you go for reading the scenario, so it will be a worthwhile reading. So you would be picking the relevant options, the relevant things, the relevant points from this scenario as you have already read the requirements. So that's the planning aspect, that how to attempt paper. What are the requirements basically? You should assume today's date is 1st September, calculate requirement A, calculate. Now another thing to decide, that which area we should use for responding this question. Either we should use word processor or spreadsheet. So it's all depends on the requirements of the question. However, you are not restricted that you must have to use word process or a spreadsheet. It's not like that. You would be deciding at your own that which thing is more suitable for your answer. Part A, calculate. With supporting calculation, the income tax saving for 7 if he claims terminal loss relief only, as there are many other options are available to adjust the losses, but calculate the tax saving for 7 if he claims terminal loss relief only for the trading losses arising in final two trading periods, and it's about 8 marks requirement. So for getting 8 marks, what is required? What should we are planning to attack this question? Basically, if there are 8 marks, it means 4 important things are there to calculate. What are those 4 things? I can tell you the 4 things by reading this requirement. First thing, the calculation of the terminal loss. Second thing, how the terminal loss would be adjusted, means how a person can get relief by adjusting the trading loss. Number third, as question is asking about the income tax saving thing, so it means by adjusting this trading loss, we should also calculate the income tax saving for responding properly to the requirement A of the question. So the third thing will be normal income tax liability. How you will find the tax savings, by the way. In case in the absence of normal income tax liability, means the income tax liability before adjusting this terminal loss. What's that income tax liability? Next thing, calculate the revised income tax liability, means after adjusting this terminal loss. So then finally you will get the income tax saving. B, explain the capital gain implication for 7. The first 2 requirements, the A and B, are pertaining to the individual person, as he disposing business, getting loss, and in part A adjusting this loss and getting relief. Now after cessation of business, disposing few business assets, and explain the capital gain tax implication for 7 which arising from the sale of business premises and specialist machine to Patent Limited, and also calculate the amount available to 7 from the sale of these assets after paying any CGT arising. 2 things, the tax implication on the disposal of business assets. Number 2, the post-tax income, means any cash, any income after paying any CGT liabilities. So first of all, let's try to start with the part A of the question, and for responding part A, I'm using the spreadsheet, but over here we have scenario in front of us now. In scenario 7, ceased trading on 31st December 20 in the fiscal year 2021, sold his business premises and a specialist machine to Patent Limited, which is an unconnected company. And asset disposal date is very important, because for claiming BADR we have read this point that if any asset being disposed after 3 years of business cessation, so only that asset we can claim business asset disposal relief. And you can see within 3 months time period the assets are being disposed of, and there are two assets, the business premises and a specialist machine. Has income from business, see below, and part-time employment income is 6,000 per year, uses his annual exemption amount, and for capital gain tax purposes means any gains if arise, they will be directly multiplied with the CGT rate, because has already used the annual exemption. Sabin's unincorporated business. Sabin commenced in business as a sole trader on 1st July 12, and business ceased on 31st December 20. It's more than 2 years holding period. Overlap profits from the commencement of the business are 7,800 to be used in the calculation of terminal losses. Furthermore, the tax adjusting trading losses for the year ended 30th June 17, 44,000, 30th June 18, trading profits are 32,000, 30th June 19, 21,000, year ended 30th June 20, that is 4,000 loss, and the 6 months period 31st December 20, 23,000 loss. Sabin sale of business premises and specialist machinery to Patent Limited on 1st April 21. Business premises purchased on 1st July 12, specialist machine purchased on 1st May 17, and disposing these assets on 1st April 21 means the acquisition date and the disposal date time period is of more than 2 years, and the assets are business assets, so we can claim reliefs if any available. Cost 86,000, disposal proceeds 114,000, 49,000 is the cost, and disposal proceed is only 41,000. The business premises had been wholly occupied by Sabin's business throughout his period of ownership, means this business premises is simply a business asset and always being used for trading purposes only. Sabin had claimed capital allowances on the disposal of specialist machinery. By the way, if this machine disposed for 41,000 whereas the cost was 49,000, you can see there is a loss of 8,000, but this loss cannot be classified as a capital loss because Sabin had claimed capital allowances on this specialist machine, and we have already discussed this point over here in the discussion of assets, that on the disposal of asset on the plant and machinery, these are exempt from capital gain taxes, so any gain is not chargeable, any loss is not allowable, because on plant and machinery items normally we claim the capital allowances, so these assets are exempt from capital gain tax. Okay, what next is there? So we have read the scenario with respect to Sabin. Now I'm going to answer all of these things. And for answering all of these things, I'm opening a spreadsheet area. So please be with me now. I will try my best to show you that how you would be writing your answer in exam. Terminal loss relief and income tax saving. So that is the first formal heading for the part A of question 3. First thing to calculate terminal loss. Terminal loss is any loss which is in the last 12 months of trade. So basically the last 6 months time period loss is 20 3,000, whereas further 6 months loss can be taken from the 4,000 total loss amount. So going to use the same amounts. Last 6 months loss, a negative amount of 23,000, whereas remaining 6 months, because we should count a complete 12 months time period, remaining 6 months loss would be calculated from is equal 4,000 is an amount for 12 months and we require only 6 months loss amount, and if it is a loss amount, please place a negative sign between equal sign and the bracket sign. So total terminal loss would be the sum. By the way, another thing, as at time of business cessation, we deduct the overlap profits, and overlap profits are given in the question 7,800 from the business start. So the total terminal loss will be calculated by adding up all these figures, that is 32,800. This terminal loss can be adjusted from previous 36 months trading income on a last in first out basis. So let's try to adjust this terminal loss. This loss is in the fiscal year 2021 because business is on 31st December 20, going to mark the 3 previous fiscal years as well, 19-20, the 18 and 19, and 17 and 18. Trading income for these years is given in scenario as 44,000, 32,000 in 18-19, 21,000 in 19-20, and instead of loss in fiscal year 2021, instead of this 32,800, we are reporting nil. Then terminal loss relief on a first priority basis, it will be deducted from 19-20 trading income. Then a differential amount will be deducted from the 18-19 profits. So if the total loss amount was 32,800 minus, we have adjusted 21,000 from 19-20. So a differential of 11,800 can be adjusted from 18-19's trading income. So trading income after this loss relief is calculated as the sum of these two figures, that is 20,200, and same case over here, we are adding a positive and a negative figure, so resultingly it is giving you nil. Finally, we are going to calculate the tax saving, because examiner is also asking about that how much tax is saved by adjusting this trading loss. So this tax saving is from 18-19 and 19-20. Before this adjustment, SEBIN ITL before adjustment, then SEBIN income tax liability after adjustment of this loss. Now how to do the calculation? As we know that before loss adjustment, 18-19 income is 32,000. So is equal 32,000 and an employment income is also given for each year. From this, personal allowance will be deducted and the differential will be multiplied with the basic tax rate. So that is 5,100, and what is for 19-20 is equal 19-20 trading income before this adjustment was 21,000 plus 6,000 employment income of each year minus 12,500 is the personal allowance for the year into the basic tax rate of 20%, that is 2,900. What happens after this adjustment? Doing all these calculations again, after this adjustment, 1819 revised income is now 20,200, that is trading income, plus 6,000 minus 12,500, and the differential will be multiplied at basic rate of 20%. So revised liability is calculated as 2740, whereas for 1920, if the taxable income after this adjustment is becoming 0, so same amount would be considered over here. Finally, we can take the total saving column. Total tax saving is equal from 5,100 income tax liability before this adjustment, and after adjustment is 2740, and 2,900 is a tax save, and total tax saved is equal the sum of the 5,260. Why we actually marked 0 over here? So let's write a note, because do not only show the calculation, as we wrote a note over here for the terminal loss adjustment. Same case, after this adjustment, I'm going to write another note, personal allowance. There is nil trading income, and in the 1920 there is employment income, but that employment income is actually covered from personal allowance. So I'm going to write the point over here, personal allowance covered the employment income of 1920. So taxable income is nil, and hence no income tax liability is calculated for 1920. Why we are not considering 1718? Good question. Because the loss of 32,000 is adjusted in a manner that from this 32,800, 21,000 adjusted from the trading income of 1920, and a differential adjusted from the amount of 32,000 of trading income, a differential of 11,800 from 1819. So if whole amount of loss is adjusted in 2 fiscal years, so there is no need to take the loss from 1718, because we should adjust this loss to the maximum possible extent, as 32,000 of trading income was available. So we adjusted a differential amount. So how we calculated this differential from 32,800, we adjusted 21,000 here, and a differential of 11,800 adjusted from 1819. So nothing is remaining, so that is why not deducted anything from the fiscal year 1718. Moses, is this thing clear? Good enough. Now let's move towards the part B of the question. In part B, capital gain tax implications are required. So question 3 at part B, in which we are going to tell the CGT implications and after tax proceeds. We would also be calculating the things with respect to specialist machine, and would also be explaining the things. Specialist machine, there are basically 2 items we disposed of, and other asset is business property. A specialist asset, on this asset, although this machine is sold at a loss of 8,000, where from we are getting this 8,000? The cost was 9,000 and asset disposed of only for 41,000. but still there would be no capital loss will arise. Why the capital loss will not arise? Because plant and machinery items are exempt from capital gains, and Sabin is claiming capital allowances on this asset. So nothing to do with specialist machine for the capital gain tax calculation. With respect to business property disposal, a gain of 28,000 because we dispose this property for 114,000 and the acquisition amount we purchase this property for 86,000. So resultingly a gain of 28,000 would be liable for CGT at a rate of 10% because it qualifies for business asset disposal relief. As now explain why the business asset disposal relief is available. Because Sabins owned this asset, owned this, by the way, let me clear you one more thing, business asset for more than 2 years before disposal, and it is being disposed of within 3 years time period after business cessation. As business is ceased on 31st December 20 and the assets are being sold on 1st April 21. All of the conditions are met. Furthermore, no annual exemption would be available because it is clearly mentioned in that any exemption has already been covered. Resultingly, capital gain tax liability, CGT liability, is equal 28,000. So show your calculation in a manner that how you are calculating the capital gain tax liability. A gain of 28,000 will simply be multiplied with the 10% of business asset disposal relief. That is 2,800. Final thing to answer in this part of the question, we actually answered the CGT applications, and now finally the after tax proceeds. Yeah, very right. Annual exemption is not available because she has already used this annual exemption. It is mentioned. So that is why we simply ignore the annual exemption amount. Finally, after tax proceeds, the final step. After tax proceeds. After tax proceeds are the first asset disposed for 114,000 plus another asset disposed for 41,000, the specialist machine, and he got cash in total, but from this cash this amount has to pay as a capital gain tax liability. 114,000 is the cash proceeds from business property, 41,000 is the cash proceeds from specialist machine, minus the capital gain tax liability calculated on business property, 2,800. After all these things, 152 and 200 is the after tax proceeds amount. Any questions till now? So we've also finally answered this part of the question. Let's read this scenario and also discuss the relevant areas with respect to part C of the question. Pattern was incorporated and commenced trading on 1st April 21. Expect to make such trading tax adjusted trading loss in the year ending 31st March 22. It's the first year of trade, and expecting a loss in the first year of trade, has no other source of income or gains in the accounting period. And as we discussed that for research and development purposes, it is normally given in question about the size of the company. So Patent Limited is a small and medium sized enterprise for R&D purposes. Patent Limited acquisition and disposal. Patent Limited purchased a newly constructed factory from a developer on 1st April 21. Patent Limited paid 142,000 on the factory, which includes 56,000 for land element. The factory was brought into use on 1st May 21. Keep remember, check the acquisition date, that is 1st April 21. Whereas the factory was brought into use on 1st May 21. Means from April, we should not be considering SBF from April because that is the acquisition date. The factory was brought into use on 1st May 21. So from 1st May 21 till the year end date of 31st March 22, only the 11 months SBA would be calculated and deducted from the trading profits. Patent Limited Research and Development. One of the Patent Limited employees is wholly engaged in qualifying research and development activities at an annual cost to the company 40,000. Patent Limited also engages external subcontractors provided by unconnected companies. The total cost of these will be 22,000 in the year ending 31st March 22. By the way, we would be taking 65% of this 22,000 thing. Because we have read this statement, for subcontract work, only 65% of the cost incurred would be qualified for the calculation of eligible expenditure. What are the requirements? Explain tax deductions and reliefs available in respect of the acquisition of factory, and number 2 on the research and development. So let's start attempting this part of the question. That is very easy, not difficult. Okay. Question number 3, it's a part C. Here we are going to tell about the tax deductions and reliefs available to Patent Limited. And there are basically two expenditures. First one is acquisition of new factory, and after skipping few lines, I'm going to mark the second heading as expenditure on research and development. So as per the requirement, we are dividing the answer into two things. Patent Limited can claim commercial structure and building allowance at straightforward 3% on the acquisition of new factory, but excluding the land element. First of all, we are going to tell the tax implications. Then we'll also be showing the answer through calculation as well. Furthermore, only only 11 months 11 months expense can be deducted as the property being used in business from 1st May 20 till 1st May 2021, the brought into use date, till 31st March 22, that is the year end date. Finally, what is the amount of SBA expense? The final step is equal, what is the total value for which we acquired asset? That is 142,000. But from this 42,000, deduct 56,000, the value of land, and multiply the differential with the 3% SBA percentage, and then further multiplied with the 11 upon 12. Resultingly, 2362 is the allowable expense. Anything to ask till now, please? Are you guys clear with the discussion and the treatment of the SBA? Yes, my dears. Good enough to know. Okay, let's move on. With respect to research and development, first of all, mark this thing as Pattern Limited is SME, small medium size entity, for R&D purposes. So an additional 130% of the eligible qualifying expense can be claimed from trading income. In the next step, we are going to tell eligible expenditure. Eligible expenditure would be the employee who is directly working in research and development, employee's salary who is dedicatedly working for this research and development. The per year cost is 40,000. Furthermore, another allowable expense is that subcontract work. But from this, how much we can take max is equal 22,000 is the total amount, but of which 65,000 is eligible. So the total amount would be is equal the sum of these two, resultingly 54,300. First of all, we calculated the eligible expenditure. Now taking the 130 of eligible expense, if it's a 100% value, how much we require? 130%. So 54,300 divided by 100% into 130. So 130 of the eligible expenditure is 70590. In the final step, total trading expenses which can be deducted from the trading P&L are calculated as is equal the actual amount of employee as peer you are asking, wouldn't we be mentioning the years at the 3 and 4 year? He actually, examiner is not asking that how it will be available and all that. He is actually want to know about the tax implication of the expenditure incurred. So for the and specifically the tax implication for the year ended 31st March 22. So no need to waste your time for explaining additional points because you would not be getting any marks. Keep remember the professional papers are purely based on your planning thing. So please think more and write less during exam. So please also don't waste your time by writing additional more points which will not be resulting in any marks. So total expenditure is 40,000 plus 22,000 plus at the additional amount of, as we just calculated 70590, this amount can additionally be deducted from the trading profits. So resultingly 132,590 is the total amount which can be deducted from the trading profits. Another question from Muhammad, 130 of the staff cost, 130, no, not for staff cost. Staff cost can be taken as full. The 65% rule is for when there is any work which outsourced basically. So as it is mentioned in scenario, patent also engages external subcontractors. So whenever there is agency work involved, from the 22,000 we would be taking max 65% of this expenditure incurred for eligible expenses. However, the whole amount can be taken as a deduction from the trading profits, as we deducted 40,000 plus 22,000 plus the eligible expenditure, the 130% of the expenditure incurred which qualified for research and development purposes. So 132,590 is the total trading expense, highlighting it. Further, as Pet & Co, as it is mentioned, it's a loss-making entity in first year of trade, is a loss-making business. So from these two options, if a company is a loss-making company, how to adjust that loss? Option 1, that loss can be surrendered, or option 2, that loss can be adjusted by using other options. As you can see, it's a first year of trade, means we cannot use any of these and no other income in the current year, or we cannot carrying the loss back or carrying the loss forward. However, company should surrender the loss and can get a repayment at 14.5%. So writing the same point over here, P company is a loss-making business, so and can surrender the loss up to 230% of the qualifying expense of 54,300. In return, why company would be surrendering this loss? What is in return? In return, for a tax credit from HMRC at 14.5% of the loss surrendered. Now we're done with the discussion of the very first question. And if you have any queries now, my dears, you may please ask in the chat box. Moses, as you are asking for carrying the loss forward, keep remember in losses situation, company wants cash flows normally. However, you can do that, but normally in the loss-making situation, business wants cash flows. Instead of carrying the loss forward, if company surrender this loss and can get a repayment, the cash inflows from HMRC. So I guess this surrendering option is more beneficial for the company, because in the very first year of trade, company is incurring expenses and in shortage of cash flows. That is why company can surrender this loss for getting a repayment from HMRC at 14.5%. Yes, we can take a break, a 10 minutes break now, as we're done with the first question. So after break, I will be discussing the relevant areas for question 2, and then we'll start attempting question 2. So it's a 10 minutes break. Welcome back. Before moving on towards the next question, so what we are going to do now, we are going to quickly recalling the respective areas which tested in exam question 4 of the September-December 21 exam. The first topic is the concept of part sold. This concept is pertaining to the capital gain taxes. This concept is applicable when a person sold any part of an asset. Let's say, for example, 10 hectares of land purchased few years back, and now in the current fiscal year, 3 out of 10 hectares are being disposed of. So for calculating the cost of 3 hectares, cost of part sold will be used. Because why I would be using this formula for the calculation of the part sold? Because in our example, we didn't purchase 3 hectares separately. We purchased actually 10 hectares, of which now 3 hectares we are disposing in this fiscal year. So at time of disposing a part, cost of part sold is calculated using this formula: market value of the part sold divided by market value of the whole asset into the original cost, the original purchase price. Further thing, in capital gain taxes, any asset which is transferred between connected persons. What are connected persons? Your parents, your siblings, in-laws, all these are connected persons. Spouses are not connected persons. Any transfer between spouses is exempt from CGT. So what are other persons which are to be considered as connected persons? I repeat, the in-laws, the family members, siblings, the parents. And HMRC says if there is any transaction between the connected persons, that transaction will always be recorded at market value, and gift relief or holdover relief would be available if the asset is a business asset. So first thing, any asset, any transfer between connected person from CGT purposes will always be recorded at market value. And if the asset is a business asset, so then two reliefs can be claimed. If there is a gift situation, gift relief can be claimed. And if asset is disposed at below the market value, so the holdover relief can be claimed. Can you guys hear me properly? All right. Further thing, IST in installments. A general rule is that any IST payment at time of death would be payable in 6 months time period, and 6 months time period should be counted from the month end of death. For example, if a person dies on 13th March, so first of all, take the month end date, and from this date count the next 6 months, and on this date any IST would be payable which is calculated at time of death. But there is a concept for paying IST in installments for non-liquid assets. Means the asset is of a nature which is non-liquid asset, means that asset cannot be readily converted into cash. So if any IST calculated on that non-liquid asset, then a person can opt for paying IST in installments. For example, what are the types of non-liquid assets? Any property or unquoted shares. Then taxpayer have options to pay tax in installment, IST payment in installments. Option 1, take out the, for paying IST, now the the taxpayer has two options: take out the loan to pay IST, and any interest on this loan would be calculated and deducted from the total income with the name qualifying interest. From income sheet pro forma of the individual person, we can deduct qualifying interest from total income to get a net income, and qualifying interest which is an interest which is for on a loan and loan acquired for qualifying purposes. And one of the purpose, if a person is acquiring any loan to pay IST, then on such loan if any interest is calculated, that would be the qualifying interest. But instead of taking a loan, if there is a non-liquid asset, another option is available for that person. Person can pay tax in 10 installments, but this option will only be used when there will be a non-liquid asset. Then pay tax in 10 equal installments, first due on the normal IST due date. What is normal IST due date? That is 6 months from the month end of death. Person would be paying IST in installments in 10 equal installments with the first due on normal IST due date, then annually thereafter on the same date. However, if asset is sold within 10 years time, all remaining installments become payable immediately. Let's say there is a property, and on such property an IST is calculated, but this property is a non-liquid asset and person want to pay any IST in installments. But if the person is disposing the asset within 10 years time after this installment option, so all of the remaining installments will become payable immediately. Another area is with respect to IR35 personal service company. Under tax avoidance legislation, if the tax affairs are managed in a way to reduce the tax liability, that is termed as tax evasion. Sorry, tax avoidance. Tax avoidance means arranging your tax affairs in a manner within the boundaries of law, so tax liabilities will be a lower figure. So when such types of arrangements exist, at the same time HMRC introduced anti-avoidance legislation, and IR35 personal service company is one of the anti-avoidance legislation. Objective and consequences: if IR35 personal service company exists, then the whole income received from any company, from the personal service company, from the PSC, would be considered or treated as employment income for tax purposes rather than dividend or any other source of income. Being treated as employment income, NICs would also be payable, means no concept of other income. By the way, what normally a person can do is that person can register a company by his own name and providing services to other client, and in return getting an invoice amount and then withdrawing funds in the form of dividends. But let's say if this company is being created by providing services to a single client, so the company created by the person would be considered as a personal service company, and any income from that own company would be considered as employment income, means all of the rules and regulations with respect to employment income are applicable. So here are the calculation steps for person and company. Amount received in the fiscal year, this pro forma would be giving you 5 marks in exam questions. Less statutory deduction at 5% of the amount received by the company. NIC is paid by employer, and we know that for first 8788 there is nil NIC by employer, and on excess amount employer would be paying NICs at 13.8%, less pension contribution made by employer and less any salary paid by employer. after these deductions, this amount would be considered as a deemed salary, including employer's NIC. If it's a deemed salary, deemed gross cash earning, so it means it's a 113% amount. On this one, from this 113% amount, deduct the employer's NICs, taking the same amount as here, multiplied by 13.8% divided by 113.8. So employer's NIC would be calculated. Ignore any dividend paid by personal service company. So resultingly deemed salary of the person would be calculated. By the way, he is also getting actual salary plus deemed salary. Both would be considered as in the calculation of the total salary for that employer, for that person. From this total salary, if there is no other source of income, this total employment income would be considered as total income. And from total income, if qualifying interest is deducted, net income is calculated. Then from net income, if personal allowance is deducted, so that taxable income of the person will be calculated. So normally when there is personal service company in the question, we would be simply following this pro forma to get straightforward 5 marks. And you will see in the question which we are going to attempt now, there are calculations required for personal service company, and a taxable income is required for the person. Any questions till now, please? I'm looking towards the chat screen. Yes, my dears. Okay. Let's move forward. And here is the concept of UK resident and UK domiciled. Okay, let me guide you over on the NIC thing in the personal service company. By the way, person created a company by his own name, but HMRC at the same time introduced an anti-avoidance legislation with the name personal service company. So all the things, any amount received in the year, then few deductions are there as per the guidance of the HMRC. Statutory deduction is always there at 5% of the amount received. Means we would be taking this amount over here and would be multiplying with the 5%, so it's a statutory deduction. Then as we know that if the company is paying any gross cash earning, at the same time employer has to pay class 1 NIC, that is an allowable deduction for employer, for the company. On the gross cash earning, class 1 NIC is also payable by employer, and that is a deduction from the profits. So that is why we are deducting this amount. Furthermore, after all these deduction, this amount is calculated is deemed gross cash earnings available in the company. Now, as it's a gross amount, deemed gross amount means in this amount NIC is also added. Now we are going to deduct again the NIC amount at 13.8% by considering as if it's a gross figure, so its percentage will be 113%. So this amount, the Y amount, if it's a gross amount, so its percentage will be 113.8. And as we require employer NIC over here, so employer NIC is 13.8%. So this is how we would be calculating the NICs paid by employer. Moses, are you clear now? Good enough. Next thing is UK resident and UK domiciled. Let me explain you from this slide. The main theme, the main idea is that if a person is UK resident as well as UK domiciled, if a person is meeting both statuses, if the person is UK resident as well as UK domiciled, that person has to pay tax. If both conditions are met, then person has to pay UK tax on worldwide income, irrespective of the fact that whether person is remitting any income to UK or not. Let's say, apply this situation on yourselves. You are UK resident and domiciled, and let's say you have any other source of income in any other country, but as you are resident in UK and also domiciled in UK, so irrespective of this fact that whether you are remitting the foreign income to UK or not, you have to pay UK tax on the worldwide income. Why? Because you are also meeting domiciled status. So it means the same amount which you are earning in foreign country is also taxed in that country, but due to this domicile status thing, you would also be paying UK tax on the foreign income as well. It means you are paying tax twice. At the same time, there is a concept of double taxation relief. If a person is paying taxes in two different territories, so normally if the treaties existed, do follow that treaty between those countries. In the absence of any tax treaty, if the income is being taxed in both countries, at the same time, double taxation relief can be deducted in UK. And double taxation relief is the lower of the foreign tax or the UK tax. I repeat, if an income is being taxed in two different countries, so then a double tax, in the absence of any tax treaty, the double taxation relief is available, and double taxation relief is the lower of the UK tax on foreign income or the foreign tax on foreign income. So that's the main theme, and the same concept is actually examined in the next question, which we are going to start shortly. But before starting this question, if you have any unclarity in your mind, you may please ask. Then we can move forward to attempt the next question. Any queries? All right. Please don't worry, I would be covering the same while attempting this question. Please don't worry for this thing. Yes, for UK residency status, we have to check the auto residency test, auto non-residency test, and there could be a possibility for checking the ties test as well. It is written for Etisham, it is written as UK income tax on worldwide income, UK capital gain tax on worldwide gains, and UK inheritance tax on worldwide assets. It's all basically dependent upon the domiciled status of the person. If the person is domiciled in UK, then he has to bear all of these things. Okay, now you should assume that today's date is 1st September 21 and C requires advice on the capital gain tax implication of a proposed sale of antique chairs. Remember, we studied this concept, chattels and the non-chattel, the wasting chattel, non-wasting chattel. So antique, tangible, movable, but life of these assets are more than 50. So non-wasting chattel, there could be 4 possible scenarios, any of the 4 possible scenarios. C requires advice on the capital gain tax implication of a proposed sale of antique chairs. Number 2, on payment of potential IST liability in respect of 2 lifetime gifts, and the application of the personal service company legislation. Okay, 3 things are required by this first person C. His wife Emma requires advice on the tax implications of receiving overseas income. As just discussed, if person is meeting his UK residence as well as UK domiciled status, then UK tax is there on the worldwide income. What are the features of UK resident and domiciled? Good question. For answering this, I would be sharing the same file in the WhatsApp group. So there are the details available. You can go through the things. If still you feel any unclarity, you may please ask them. Now, following exhibit with respect to C and A requirements. What are the requirements? Explain with supporting calculation the capital loss which will arise on the proposed sale of the antique chairs. Now we are clear with one thing, that there will be a loss on the disposal of the antique chairs, as it is clearly mentioned in question. And after calculating this loss, how this loss will be relieved means the adjustment of the capital loss. Part A2, advice on the availability and effect of the installment option for payment of Nathy's inheritance tax liability. In respect of the investment property and antique chairs. Okay, means these 2 assets are being transferred in lifetime, and on the assumption that C dies on 20th March 26, what are the tax implication with respect to installment option on these 2 assets which are now becoming taxable at time of death? Requirement C. Note, no calculations are required for A2 only. C. Calculate Saddle's taxable income for the tax year 21-22 on the basis that the personal service company legislation applies to the budgeted income receivable by M in the year ending 31st March 22. And the last requirement is for the tax year 21-22, advise A why the interest in respect of her bank account in the country of Comore. Now you can see from the requirement is that she is getting interest income from a foreign bank account, and examiner is asking why the foreign income will be subject to UK income tax, because she is meeting the domiciled status. You will find this thing in scenario and explain if that foreign income is being taxed in UK, and then explain with supporting calculation why this will not actually result in UK tax payable. By reading this requirement, by reading this thing, the highlighted area, first thing which should click in your mind, that any tax liability can be reduced to nil by the availability of any double tax relief, because we are talking about the foreign income, and examiner is asking that why that foreign income, explain with supporting calculation why this will not actually result in UK tax payable. First thing, why it is becoming taxable in UK. Second thing, if UK tax is applied, still there is no UK tax liability, explain the reason. scenario. Please be with me and read the scenario very carefully. C is a resident and domiciled in UK, as well as his wife also resident and domiciled in UK. Both person are UK resident as well as UK domiciled. C will sell 4 antique chairs on 6th October 21, and C is the sole shareholder, director and employee of Mandini Limited. Acquisition of antique chairs. The 4 chairs which C is going to sell, where, when and for how much she acquired these chairs and how these shares are being acquired by C. Acquisition of antique chairs. C was gifted a set of 6 antique chairs by his mother. It was a gift. He actually didn't purchase a single chair, right? But we know one thing, that any transfer between connected person is always recorded at market value, as his mother gifted 6 chairs, but any transfer between mother and son would always be recorded at market value. On 3rd March 19, the chairs had a market value of 152,000 on that date. It was a gift. C paid no consideration, but the disposal would be recorded at 152,000 and the same value would be considered as a cost to C. F had purchased the chairs for 106 on 8 August 2009. Okay, but the main idea is to know about the cost of 6 chairs for C, that is 152,000, the transfer value of the chairs from mother to son. Sale of antique chairs. C sold 2 of the chairs to an unconnected person for 42,000 on 10 September 19. By the way, from 6 he had already disposed 2 chairs. Now the remaining 4 chairs were valued at 19,000 on that date. On which date? When the 2 chairs were sold. At the same time, the value of the remaining 4 chairs, was 93,000. C is proposing to sell 4 remaining chairs to his son. Son is a connected person, and the disposal proceed. Son is paying like a consideration of 35,000. But again, any transfer between connected person will always be recorded at a market value, and market value on 6th October 21 are expected to be valued at 99,000 on that date, but he is getting only 35,000. Why getting a lower amount? Because the disposal to son, to a connected person, that is why 4 chairs are being sold for 35,000. However, the market value on the chairs on 6th October 21 was 99,000. Then C, previous lifetime gift. C's only previous lifetime gift was an investment property to his son on 2nd July 21. You can see the disposal date. He is selling the chairs to son on 6th October 21, but in the same fiscal year, another asset was gifted to son on 2nd July 2021. This gifted resulted in a gross chargeable transfer of 380. As keep the requirement in mind, it's also about explain how this loss can be relieved. So if any assets transferred between in the same fiscal year, so any gain and loss on the assets will be adjusted with each other. So as it is also mentioned in question, on the disposal of chairs, he would be getting a capital loss, and this loss can be relieved by the gains from the disposal of the investment property on 2nd July 21, in effect in the same fiscal year. Medini Limited is a personal service company for tax purposes of IR 35 legislation, has budgeted fee income wholly from relevant engagement of 65,000 in the year ending 31st March 22, pays C, who is the sole director. C is a sole director in Medini Limited. Medini Limited pays C a gross monthly salary of 1,500. Keep remember, it's a monthly salary, so the whole year salary will be 18,000 by multiplying 1,500 with 12 months. will pay C a dividend of 35,000 that is to be ignored for IR 35 purposes. Neither C or nor Mandni Limited has any other source of income. Okay. So first of all, let's try to complete the first half with respect to the person C, his lifetime transfer, his disposal of antique chairs, and the loss adjustment and all that. I'm going to open a spreadsheet area, and first of all, I would be marking relevant headings. As we are attempting question 4, and question 4A requirement is basically divided into two parts. So A1 is the disposal of antique chairs and available loss adjustment. Disposal proceed would always be recorded at market value of 4 chairs, that is given in scenario as 99,000. Simply ignore 35,000, the actual consideration received, because any disposal proceeds between connected person would always be recorded at a market value. From this, deduct the cost of 4 chairs basically. For this, we are going to prepare a working number 1. Before the disposal of 4 chairs, he had also disposed 2 chairs out of 6, and those 2 chairs were disposed for 42,000 is equal sign for starting a formula 42,000 divided by the value of parts sold divided by the value of the whole asset at disposal time. When the 2 chairs were disposed at the same time, the remaining value of the remaining 4 chairs was 93,000 multiplied with the original cost. By the way, disposal of his mother would be considered as the cost to son, because his mother gifted the chairs to son, but again transfer between mother and son is considered at market value. So 152,000 would be considered as a cost. So 47288. How to round off it? Custom number 0. Okay. Select the relevant cell. Formatting custom in the number, write 0 and okay. So this is how we round it off. So it's a cost of 2 chairs sold. Now cost of remaining 4 chairs. Why we are considering cost of remaining 4 chairs? Because this cost now would be deducted from the 99,000. How to calculate it? Very easy. The total cost was 152,000, from which if we deduct this value of 47289, so it's giving you 104711. Again rounding it off, custom number format 0 and okay. I'm considering the same cost over here, but with a negative sign, is equal negative sign. Select the relevant cell. You can see there is a loss on disposal calculated is equal sum bracket start, that is 5711. This loss, now going to tell the loss treatment. This capital loss on the disposal of 4 chairs, on the disposal of antique chairs, as you can see, disposal proceed and the market value both are more than 6,000. So the normal calculations are to be performed. So if we perform the normal calculations, so we calculated a loss amount, and after calculating this loss amount, what is the relevant adjustment available? That this loss to be this loss on the disposal of antique chairs can be adjusted from the other gains calculated on the disposal of investment property in the same fiscal year. Why there is no relief available? Because antique chairs is not a business asset. So in the absence of business asset, no gift relief or holdover relief is available. Because for claiming these reliefs, the first condition is that the asset should be a business asset. But antique chairs is not a business asset. That is why not claiming any type of relief here. Is this thing clear? So this is how the loss can be adjusted. Yes, my dears. Any question, query from your part? All right. Good enough to know that you guys are clear. Yes, I can open cell 35. Which value you actually want to? Can you please specify me the value so I can click on that cell, that specific cell? Okay, 104711. How the cost of two chairs calculated, and then the cost of unsold part. So as we mark, this loss can be adjusted. This capital loss would be adjusted from the gains on the disposal of other asset in the same fiscal year 2021. Basically, Shardil, here we have to calculate the cost of two chairs which being sold in past. That is calculated. The disposal of two chairs was 42,000 divided by the market value of whole asset, 42,000 divided by remaining value of four chairs multiplied with the original cost. First of all, we calculated cost of two chairs and then the remaining cost of four chairs from 142. If two chairs which being sold, if the cost of those two chairs is 47289, so a differential of 104,711 is the cost of unsold part, and unsold part was four chairs, and now we are taking the same value over here. Next thing, part A2 of the question. In part A2 of the question, examiner wants to know the installment options on IST implications on lifetime transfers at time of cedent's death. as you can see, in this scenario, it is very clearly mentioned that this asset being transferred in life on 6 October 21, another asset transferred on 2nd July 21, and in the requirement section, what will be the tax implication if Sedens dies to be dies on 20th March 26. You can see both assets are becoming taxable at time of death because they are falling within the 7-year time period after death. So we are going to write the same point over here. Both the lifetime transfers are becoming taxable at time of Sedan's death if he were to die on 20th March 26. In effect, within 7 years time, after the assets transfer date. No need to highlight when the assets transferred. You looked in the scenario, you concluded the point that assets are being disposed and they are becoming taxable in the 7 years time period. So now, is the installment option available on the investment property? Investment property installment option, is that available on the second asset, antique chairs, which are becoming taxable? For both, we have to tell about the installment option. Investment property, is it easy to sell the investment properties? Is it a readily converted into cash item or not? What's your points? Think. Installment option for paying. Yes, I'm looking towards the chat option. You guys are doing multiple replies. So let me conclude the installment option payment for IST purposes is that installment option for paying IST arising on this asset would be available. Why it would be available? As investment property is not a liquid asset. Why we are saying that it's not a liquid asset? Because it takes time to search for a buyer, for sale binding agreement and all that. It takes time. So investment property is not a liquid asset and cannot be readily converted into cash. So any asset which is not a liquid asset, on such asset installment options would be available. Antique chairs which are becoming taxable at time of death. There are multiple persons who actually search for any antiques, the paintings, the vases, and the old things. Means whenever they come to know that there is any asset, they wish to buy the asset as soon as possible. So over here, as antique shares are becoming taxable due to that within 7 years of transfer time. So installment option for paying IST would not be available as it is not, it is a liquid asset, it is a liquid asset and can be converted into and can readily be converted into cash. So if any asset which can readily be converted into cash, so that asset is a liquid asset, and on liquid assets no IST installment option is available. IST installment option is only available for those assets which are not liquid assets as investment property above. We done with the part A1 and A2. Now let's talk about the part B of the question, which talks about the advice on the the calculate taxable income under PSC rules. So very easy. We would be simply following this format to answer this specific 5 marks part of the question. Before we start answering, first of all, mark the reference. What we are going to do now, we are going to answer the part B, Sedans taxable income for the tax year 21-22 on the basis that the PSC rules apply. As we have read the scenario, I'm going to take the figures directly. Amount received amount is 65,000. Amount received is 65,000. From this, less statutory deduction. How to show the calculation is equal, we know this, that's the amount received into 5% of this value, and we want to deduct this 5% value. So after this is equal sign, please mark a negative sign. So it's becoming minus 3250. Then less NICs payable by employer and what are the calculation steps. Please be with me. I'm going to show you directly. Employer pays NIC at 13.8% on the gross cash earnings. And what are the gross cash earning in the question? Amount of salary paid 15 a month, and there are 12 months basically. But if any amount is calculated, of which the first 8788 on which there is no NIC applicable. So that's very important to understand. We are taking the figure in a single step. Amount received in a fiscal year, statutory deduction, then NICs, 1500 a month salary multiplied with the number of 12 months minus to the extent of first 8788 there is no NIC payable by employer. So if any differential amount is calculated, on which amount 13.8 is applied. So 1271 is amount calculated. If you want to round it off, go to option custom, then it's 0. Okay, and as we are deducting all the things, again after this is equal sign, then place a negative sign, so it's minus 1271. Following the formula, following the format, less salary paid. Salary paid amount is 15 a month into number of 12 months are, then it's 18,000. Again, we have to deduct a negative sign, and deemed salary is calculated, including employer NIC is equal sum bracket start all of the amounts to be considered in the calculation. So 42479. Now, if this 42479 is a gross amount in which NIC is added, now employer NIC is equal, this value is a 113%, 113.8 in percentage terms, and we required 13.8% of the same value, that is 5151. And as we have to deduct again a negative sign after this, deemed salary for SEDN is equal sum bracket start adding both figures, resultingly it is 37328. Furthermore, examiner is asking about the taxable income. What will be the taxable income for C for this fiscal year? So till now we just calculated the deemed salary from personal service company. In the next step, what we can do is that now we can move forward to other steps, like you can see from total income, how to calculate this total income. You can see is equal total employment income is calculated as the deemed salary plus the actual salary received in the fiscal year. So adding both, so the total income for the person is calculated as 55328, and each person in UK receive a personal allowance amount of 12,500. After deducting this, taxable income would be calculated is equal sum bracket start adding both figures, and it's giving you the requirement answer 42828. You can easily get 5 marks by following the forward format in the calculation of IR35 personal service company. Yes, my dears, any questions till now? As you are asking questions while discussing this format from the PDF, now it's the practical implications are in front of you. Still you feel any query, you may please raise your query. All right. Now, as you are asking for, examiner actually, okay, let me guide you over this. As taxable income is to be calculated, so for getting the taxable income, first of all, we have to find the deemed salary as per the IR35 rules, then total employment income, the sum of actual salary and the deemed salary, that is becoming 55328. Why we are considering it as a net income as well? Because there is no qualifying interest is given in question. If qualifying interest is given in question from the total income, we deduct the qualifying interest and get net income. In the absence of qualifying interest, the same income can be considered as net income. Then deducted the personal allowance amount of 12,500, and resultingly taxable income is calculated as 42828. The last requirement for his wife, Emma. Emma is a resident and domiciled in UK. earns employment income of 45,000 gross each year, receives interest income in respect of bank deposit in Comore, and also makes a pension contribution of 3,000 net each year. By the way, what's the impact of this pension contribution, personal pension? So this personal pension contribution will result in increase of basic rate band and high rate band with the gross amount of this 3,000. By the way, gross amount of this 3,000 will be 3750. How to make it gross? Person's contribution is always considered as a net amount, and net amount would be 80%. To make it gross, further 20% is to be added, and after grossing up 3750, and by 3750 we would be extending the basic rate band and the high rate band as well. Emma's bank account in Comore. On 1st Jan 21, A deposited 150,000 in a bank account in Comore in the foreign country. The bank account pays interest at a rate of 5% gross each year. A will not remit any of the interest income to UK, irrespective of the fact that she is remitting any income or not in UK. If she is a UK domiciled person, he has to pay UK tax on her worldwide income, including this interest income as well. The tax regime in Comore. Tax is withheld at a rate of 18%. So from here you can see tax rate in foreign countries 18%. Tax is withheld at a rate of 18%, and all of the interest income arising in Comore. The UK does not have a double tax treaty with Comore. What does it mean? If there is no double tax treaty exists between UK and Comore, so it means double tax relief would be available if any UK tax is calculated on the foreign income. So in the part C of the question, for the tax year 21-22, advise A, why interest receivable in respect of her bank account in the country of K will be subject to UK income tax, and explain with the supporting calculation why this will not actually result in any UK tax payable. So what's the simple answer? As question number 4, part C, interest arising on Emma's bank in Comore. Bank account in Comore. As ML is resident and domiciled in UK, so any worldwide income would be subject to UK income tax, irrespective of the fact that she is remitting any income to UK or not. As it is mentioned in scenario, she is not remitting any income to UK, but still she has to pay UK tax on worldwide income. What next is there? It means any interest income from foreign bank account would be subject to UK income tax. In the tax year 21-22, she is making a contribution in personal pension scheme, which will result in increasing the basic and high rate bands with the gross amount of the contribution made. In effect, by 3750, and show your calculations in bracket that how you calculated this 3750. 3000 is the contribution amount divided by 80%, gross amount will be 3750. Revised basic rate band is now 41250. Where from I'm getting this 41250? As we know that 37,500 is a basic rate band, adding the gross amount of this personal pension contribution. So the revised limit of this band is 41250. It is also mentioned in question. Very right, Ayaz. You are perfectly your answer is perfectly fine. Now, another thing with respect to this person is giving 45,000 is the salary, and you can see the impact. If 45,000 is the salary given in the fiscal year, from the employment income, from income from other source, income from other source will be reduced by personal allowance and hence 32,500 is calculated. Where from I'm getting this 32,500? Because from this salary, if we deduct the personal allowance amount, so resultingly a differential of 32,500 is calculated. And if foreign interest income is added to foreign interest income is basically how much she invested, 150. On the 150,000, they are paying interest at a rate of 5%. So it is becoming 7,500. So if foreign interest income of 7,500 is added to 32,500, it becomes 40,000, which is still lower the available band limit as just calculated above. The band limit, the revised band limit is 41250, which is still lower than the available band limit of 41250. It means interest income would be taxed at basic rate of 20% and resultingly after deducting interest income exemption, of 1000 for basic rate taxpayer. As we know that interest income is exempt, 1000 for basic rate taxpayer and 500 for high rate taxpayer. So if total interest income is 7500 minus 1000, a differential of a differential of 6500 is to be multiplied with the 20%, and it's giving a value of 1300. So it's a tax on interest in UK, whereas 18% tax is applied in foreign country, and it becomes 7500 into 18% the foreign country tax rate, it becomes 1350. Hence the lower is UK tax, and it would be considered as double tax relief. UK tax on interest income UK tax of 1300 on interest income is to be covered from double tax relief of 1300, resultingly no UK tax liability is calculated on foreign interest income. So we answered the last part of the question as well, and as we tried, we are now effectively able to complete both questions in today's session. Are the things clear, my dears? Any questions from your part? All right. Good enough to know. If there is, whenever there is no tax treaty exists between UK and any other country, so there is always a double tax relief available at the lower of UK tax on foreign income and foreign tax on foreign income. There is no doubt on the availability of double tax relief when there is no tax treaty exists between UK and other country. Okay, Peer, I'm going to summarize the last point. As you can see, this interest income of 13,000 is being taxed in UK. So it means from 7,500 as per the UK tax laws, 1000 interest is exempt from basic rate taxpayer, and the differential would be multiplied with the 20% as the person's status is basic rate taxpayer, because total income of 40,000 is still be lower than the available amount of first band. So we applied 20% on the differential amount of interest income, so resultingly 1300 tax calculated on interest in UK, whereas the high rate of tax is charged in foreign country. So the same amount of 1300 is covered from the double tax relief. So any tax calculated of 1300 on foreign interest income in UK is covered from the double tax relief to the extent of 1300. So resultingly, there is no tax liability. Are the things clear? Okay. Okay, my dears, now we can conclude today's session. I would advise to please recall these two questions, and inshallah we will be attempting further two other questions in tomorrow's session. Take care and stay blessed. You all are welcome, my dears.